Hello, everyone. This is Mark Anderson, Home Loan Officer with Carrollton Bank in St. Louis, Missouri, presenting episode 1 of a series I'm calling the 5-Minute Mortgage Class. My goal with this series, with this class, is to teach people how to save money on their mortgage and how to make the best choices as it relates to the different mortgage programs that are out there. In this episode, we're going to tackle how to win the private mortgage insurance game. Well, as I came up with the name of this episode, I was reminded of the movie from the early 80s, War Games, with the iconic line, "The only winning move is not to play." Now, certainly private mortgage insurance is less dramatic than global thermonuclear war, but the point remains the same. The best way to win the private mortgage insurance game is not to play it at all or not to pay any private mortgage insurance. Well, how do you do that? You've got to put 20% or more down, and you've got to utilize a conventional loan program. Now, 20% down. If you can comfortably come up with 20% down and still have savings left over, great. Avoid PMI, use a conventional loan. That's fantastic. If you will completely deplete your savings with 20% down, I'm not sure that I would 100% recommend it. What I would recommend that you do, if 20% down is going to be a stretch, I would recommend that you continue watching the video and look at some of the options that you have with a conventional program for how to pay the private mortgage insurance. There might be a way to do it that's less costly than you think. Now, it's important to point out that other popular loan programs, FHA, VA, USDA, these programs have one-size-fits-all private mortgage insurance option. If you use an FHA loan, you don't really have choice A, B, and C as it relates to the private mortgage insurance. In fact, FHA has changed their rules over the past couple of years to the point where even if you put 40 or 50% down on the 30-year fixed FHA mortgage program, you cannot avoid private mortgage insurance no matter what. So if you want options and you can't quite come up with 20% down, you're going to want to look at a conventional loan to see what those options look like. All right, obligatory math warning. There is a fair amount of math up around the bend. Just hold on tight. I've got you. All right, we've got an example here. Now, I need to quick caveat. This example is for illustrative purposes only. It is not meant to indicate a particular quote for a particular person on a particular day. These are real numbers, but it's a hypothetical example. All right, we've got in this example a $200,000 purchase price. We've got a 5% total down payment, which leaves us with a $190,000 loan. Now you'll see that I've got 3 segments here. I've got monthly, single premium, and lender paid. Yes, these are the options that I mentioned before. Most people assume, and most loan officers only talk about one option, which is the monthly PMI. As we're going to see by the end of this video, the monthly option may not be mathematically the best choice for you. And we're going to break that down. The monthly PMI option, in this case, let's say our interest rate is 4.25% on a 30-year fixed rate loan. That gives us a principal and interest payment of $935, and the PMI fee every month is going to be $65. This means before accounting for property taxes and homeowners insurance, we're looking at $1,000 a month on this mortgage program, with $65 of it coming in the form of the private mortgage insurance. Now, the feature of this program is that eventually you get to knock out the $65 a month. After you pay this loan down for 8 years, you will reach an equity position that means that you're eligible to remove the PMI. Over that 8 years, you would have spent $6,240 on private mortgage insurance. So that is our basis of comparison for these other options. Single premium. Well, how does it work? Instead of paying a monthly fee, the PMI companies take a chunk of money from you right now. Think about how if you win the lottery, you've got the option of taking the monthly installments to reach the total amount, or you can just take a smaller amount, but you get the money right now. It's the same thing for PMI. So in this case, your interest rate is the same, 4.25%. You do not pay $65. You just pay the $935 a month. There is no monthly mortgage insurance, so your total before taxes and insurance is $935. Now, you do have to pay up front this lump sum premium. It is $3,240, which, hey, that is a heck of a lot cheaper than the $6,240 that you would pay over 8 years with the monthly option. I think you'd agree, if you can swing it, that extra $3,200 is worth it mathematically. It's 50% cheaper than the monthly option. Now, what if you can't comfortably come up with a 3240? You're already only putting 5% down. Maybe you're squeezed. A good realtor can negotiate with the seller to theoretically have them cover this for you on your behalf. All right, last option, lender paid private mortgage insurance. This sounds kooky up front, I will admit. You take a higher interest rate, 4.625%. This allows you to avoid private mortgage insurance over the life of the loan. I know it sounds crazy, but let's see the math. Your principal and interest becomes $977. There's a 7. The private mortgage insurance is 0 in exchange for that higher interest rate. There is no monthly premium that you have over here. And so your total is still cheaper than the monthly option. So I really think it's worth considering that. All right, if you have any questions about private mortgage insurance or anything else related to mortgage, you can call or text me at this number. A couple testimonials. This one I'm particularly proud of. This client wanted to remain anonymous, but he did give me the the label as being delightfully unskeezy, and I take that as a huge compliment. Well, we've gone over our 5 minutes for this particular episode of the mortgage class, but I hope you learned a lot. And if you have any questions, just feel free to reach out to me. Thank you.